Equities had an excellent last quarter. Returns were up in the high single digits, at least looking at the S&P. And more than anything else, both last quarter and really over the course of the last 12 months, the factor that's driven equities has been earnings and upward earnings revisions. Earnings have really gotten a boost, and I think the markets underestimated the effect of the tax package that was passed in 2017. On the consumer side, you had a front loading of those benefits, which boosted spending at the consumer level, and at the corporate side, the reduction in tax and the provision to allow 100% expensing of capital expenditures has really been an incentive for corporations to increase CapEx spending, and you're seeing that across the spectrum and across earnings, and they're really coming in quite stronger than people had expected, and that's the single factor that drove returns. What you saw during the quarter in the appreciation strategy and the market as a whole is that technology continued to be the driving force of overall returns in the market. And technology stocks as a whole have had a great year. They're up over 20% for the year. Things like healthcare were stronger. Industrials had a very good quarter. It was a kind of a broader environment for stocks, and that led, I think, certainly in the case of appreciation strategy, which isn't a diversified strategy, to a very good quarter relative to the S&P over the course of the last year. In appreciation specifically, technology was very good. Our overall returns were similar to that of the market. Healthcare was also very strong. Industrials were strong. And then the one area that I would argue that was weaker was energy. The consumer discretionary sector has been a very difficult sector for the appreciation strategy. And the main reason for that is that you've had outsized returns in certain stocks like Amazon and Netflix that are not owned by the strategy, and I would argue from a risk-reward standpoint not appropriate for a conservative strategy like the appreciation. My expectation is that those stocks which had hurt the portfolio over the first 6 to 9 months of the year have stabilized. They've started to improve. There's more certainty. We know what the earnings are. We have a better idea of what the earnings outlook will be, what the balance sheet will be, and that they will not be a drag, but rather a help on performance as we exit the year. And so that's the significant change, I think, from something that hurt us to being neutralized, and now something which I see having the opportunity to be positive for overall returns as we exit the year. We've seen a step up in volatility over the course of the last quarter. I would expect, with interest rates rising, some of that volatility to return. But volatility gives portfolio managers the opportunity to buy things that are either sold down in a basket and should not have come down, or to make better judgments and differentiate between stocks a lot more. As you get later in a bull market, the ability to differentiate yourself through stock picking actually increases. And so as a portfolio manager, I don't mind the volatility. I think it's good for the market. I think it resets risk expectations. I think that there are no signs yet in the marketplace that the bull market, although it's, and I would argue, a later cycle or more extended bull market, there are no signs in the market yet that that it's over. That said, the appreciation strategy is a conservative strategy, and there are some things where we pulled back risk a little bit on the portfolio because our job is to make sure that we participate as much as possible on the upside, but as the market tends to get later cycle and as risks arrive, and there are some small divergences in the market, but not enough that I would argue it's a big worry. Our job is to incrementally get a little bit, as things go higher, to get a little bit more cautious and be more aware of the risks. And so I think that's where we are.